Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. I did a clip based off of why commodities are the best investments of our lifetime. I'm going to go over the market conditions behind me. When we have inflation, deflation, when market crashes happen, what 10-year yields do to the PE ratio of the S&P 500. I'm going to go over Japan's deflationary market and the conditions that existed in that in that market to show you guys what we should be looking for and what to expect going forward. So I started with the 10-year interest rate treasury bond in the upper left. It's this guy right here. We'll zoom in. And what's going on here is that I am proposing that this interest rate could potentially go up. And the reason that I'm proposing that is because of the residential real estate land values. Residential real estate land values are really messed up right now in terms of how many homes we are short in comparison to home buyers. So it's the demand supply imbalance which will drive the 10-year interest rate treasury bond up. That is what I'm proposing. In history, when you look at this, we had a larger demographic in the 1970s coming into home buying years. They were known as the baby boomers. But between the baby boomers and the millennials was a smaller demographic, Gen X. Gen X, in my opinion, created this 10-year interest rate decline over time. It was the demographic. Now, I've got right here, you'll lose me, just so it's easier to see. This is the new privately owned housing unit starts. Really, it's just new residential real estate. And what we're looking at through this home build is the real estate cycle. And it cycles up and down, up and down, up and down. Under inflationary periods is when this goes above this average line here. That's what the line is right here. It's the average. Anything where the area under the curve is a lot above it was a inflationary period so long as it aligned with bigger, larger cycles. So we've got many cycles. Here, I'll pop in here. We've got a lot of cycles that are overlapping. We have small cycles that go like this, and then we have large cycles that span over very long periods of time. The big long-term cycle is interest rates going up or down. It's like a 40, 45-year cycle. And what I'm proposing is that we are coming to the bottom of that cycle and about to head upward at the same time that we have residential real estate also heading up. We've got all these things bottoming and heading up at the same time that stocks to commodities, that ratio has never been so cheap, which will rotate the money into commodities. But here's the residential real estate housing starts, which means it's new homes being built. More new homes being built above the average gives the system a larger inflationary environment. So we had larger inflation in the 70s because of this housing boom. We had a larger inflationary environment in 2000 to 2008. But now we've got this massive problem. We had this big bubble in 2007, 2008. And during that bubble, afterwards, we didn't build enough homes. All of these foreclosures came onto the market, delaying and competing with new home builds. And since the prices went so far below the cost of new home builds, it created this massive deficit of new homes being built in relationship to families wanting to buy homes. So it created this massive shortage, the area in the yellow here under the curve. This created a massive shortage. It says the housing shortage is worse than ever and will take a decade of record construction to fix. New report says June 16th, 2021. To make up the shortage, the NAR report says the US would have to build 2.1 million homes each year for a decade, more than it has built each year during the housing boom of the mid 2000s. So if that's what this green line is that I put in here. That is the 2.1 million, roughly, somewhere in this range. What it is saying is that we have to go into a massive expansionary phase of real estate that could last a decade long, building at a 2.1 homes per year, million homes per year, which is as big as the 1970s, almost in its entirety, and as big as the peak of 2005 and 6. It is saying that we are going to have the largest real estate boom that Americans have ever seen over the next 10 years. And what you should be seeing today are rapid increase in real estate prices of residential real estate and a rapid increase in rent prices because we are underbuilt by 4 million homes. So that means that we have to build 4 million homes above this average of 1.3, 1.4 over the next 10 years. That is an inflationary environment. That right there is a huge opportunity for commodities because of the valuation in commodities. Now, another thing I want to talk about, so we've established the market conditions and why I think it's an inflationary environment. If you notice on this chart, whenever this is increasing, we've never had a recession. We've never had a deflationary blowout if we're building more homes in an expansionary phase of real estate. We only have deflations when real estate crashes. 1960, that's what these dark lines are. These darker lines. It's a crash. We came down. We didn't have a crash in the late 60s, but we had one here, crash, down, recession, down, recession, down, recession. Anything where we've got large areas under the curve, we've had recessions. This was a dot-com bubble. Recession here. So going forward, we're in an expansionary phase of real estate. That is important to identify. In order to catch the homes back up, we have to build where this green line is. Where that green line is means it's a massive inflationary environment if we can build that amount of homes per year. If we don't build them, we're going to have an increasing real estate price environment for a very long time. Looking at gold and the 10-year treasury yield, I know a lot of people think that gold goes up under declining interest rate environments. We went off the gold standard right here. Look what happened. Increasing interest rate environment. This was also a gigantic real estate price boom under this increasing interest rate environment. So from 68 to 1980, we had a massive housing boom. Real estate prices went up one of the most in American history under this time frame. It's going to be even more so this real estate boom. And I'm sure you've seen real estate prices go up even more recently than back here because the imbalance is larger than ever. But what I want to get across is that we had an increasing interest rate environment during a housing boom where real estate prices went up a lot. That is what is coming, in my opinion. Gold shot far higher under those conditions of an increasing interest rate environment. Under a declining interest rate environment and a full valuation of gold in comparison to the monetary base, we saw it decline over time and went sideways to consolidate. The last housing market boom from 2000 to 2008, which is this boom right here, is this move right here in gold. And gold usually extends a little bit past the housing market boom because inflation is delayed a little bit and it extends past the crash. So I'm expecting this type of scenario back here to be coming ahead because of how many homes we have to build and the inflationary environment and where we are in this cycle of interest rates. We've already gone all the way down, and you know what? I think we're going to have to move up like this. Now, a lot of people have said, no way, the government can't sustain increasing interest rates. The deficits will be too big. Well, if the dollar gets sacrificed, then your dollar goes away. Because this is going to be pretty inflationary, and there's going to be nothing to stop it. Which means you're going to have the largest commodity boom potentially ever. And there's nothing there to slow it down. If they can hold interest rates down. I don't know if they can. Everyone's going to be selling bonds. Now, why do bonds go down during a rising interest rate environment? I've heard some people talk about that. During an increasing interest rate environment, what that means is bonds pay, if you have a 10-year bond, you get paid, I think it's every 6 months, a certain percent. So if you have a 2% bond, which it's less than that, I think now, you get paid 2% per year for 10 years. If the interest rate goes up, that existing bond that pays 2% goes down in price to equal the value of a new bond at, let's say, 3%. Now, if it goes up and the interest rate goes up again the next year by another percent or two, that means all existing bonds that are in the system go down because they're going to have to equal each other out, those payments. Why would someone hold on to the current bond at a 2% rate if you can buy a new bond at 4%? This bond pays more out in the future. So you do a discounted net present value calculation, and those will equal each other. So in an increasing interest rate environment, the future cash flows of a lower interest rate, that bond of $100 is going to get priced lower. Maybe it's $86. Maybe it's $80. What happens if we have a massive increase in interest rates? The bonds will get smoked. They could be $100 face value, but you're selling at $20. 80% decline, 90% decline in bonds potentially if interest rates go up to certain levels. That's a ways out. And I don't know how fast these things are going to rise. I don't have all the answers, guys. I'm just telling you how things interact with each other and what to look for. An increasing interest rate environment will push bonds lower of existing lower yields. So getting back into this, here's the S&P 500 PE ratio versus 10-year Treasury yield. The 10-year Treasury yield's on the x-axis, the PE ratio's on this axis. We are currently at 34 in total bubble land. When interest rates go up, so if you notice this, interest rates going down, PE ratios go up. Interest rates going up, PE ratios contract and go down. What happens here? In the 1970 to 1989, the PE ratios were on this section over here, if you look at that color. The PE ratios contracted over time with higher interest rates. So what people do is they look at bonds with a high interest rate, 10%, 12%, 13%, and they say, I'd rather take the bond, which is a risk-free return at 10, 12%, than speculate in stocks. So they'll take the new bond, but all the existing bonds are getting priced lower and lower in this environment. So it depends where the interest rates are. If interest rates go up, it's going to put pressure on stocks to get repriced lower to contract the PE ratio because the risk-free return on bonds is going up. So people are less willing to speculate in stocks versus an environment where you have interest rates at 1 or 2%. So that's a big deal. But what I am proposing is that interest rates are going to go up because of the real estate market, because of the inflation from real estate. So here is the S&P 500 ratio. You can see over time, it usually goes between a little bit below 10 and a little bit above 20. It was cycling in this range, and then we're in ultra bubble land on the right-hand side. We're in ultra bubble land because interest rates have gotten so low. Once you go below 4%, you go into bubble land. Bubble land over here from 2000 onward, we're getting in super low interest rates. Your PE ratio when your interest rate goes low usually gets priced higher up here. So that's the current S&P 500 PE ratio of 34.78. Complete bubble land. Now here's your bond versus interest rate and the pricing. So pricing is on the bottom, interest rate is up here. When interest rates go down, prices go up for bonds with lower interest rates. Newly issued bonds yield less than old bonds, so the prices of those old bonds go up until the yields are the same. So as interest rates decline, the price goes up. Interest rate. Now, this goes in reverse. If interest rates are low and they go up, bond prices go lower and lower and lower in that environment. Here is Japan's residential property index. Japan has had a deflationary problem. Well, why is that? Demographics and Japan's residential property index of 6 major cities. 1990, a little bit past 1990, was the peak of the Japan residential property index here. It's declined ever since. It's got a little move from 2005 onward. And here's the interest rates. 1991, it peaked out, declined, and had a little pop in 2006, right here where this pop is. Interest rates more or less follow residential property index values. It's that simple. So if this was a decline here, and we had this increase in 1980s, this was the increase in 1980s of the interest rate from 2.5% to 6% right here. See that increase? Is this increase here? What do you think if we are this far underbuilt, the housing shortage is worse than ever, and we would have to build 2.1 million homes each year for the decade? What do you think interest rates are going to do if we have to build all this and our residential real estate land values rocket higher? What do you think interest rates are going to do? I just showed you all the data of Japan, what their residential real estate looked like, what their interest rates did when the index went higher. Our index is going higher for real estate. We are at the beginning of an expansionary phase, and this expansionary phase has to be the biggest we've ever seen and the longest of anything we've seen in American history. What do you think interest rates are going to do in that type of market environment? Should we be worried about a crash or deflation? I see a lot of people, they're worried. They're worried about a deflation. A deflationary crash that blows everything out comes from the residential real estate land values. When that declines, we are at the beginning of an expansionary phase. There's no deflation unless homes come onto the market. And they have to come in mass. We are so underbuilt and our inventories are so depleted. If the forbearance has homes come on, it's going to be a short-term blip. It will not last, in my opinion. It could last for 6 months to a year, but it's not going to last for a decade or two or 3 years, I don't think. We're too underbuilt. So if residential real estate land values determine if we're in expansionary phases or in deflations, inflation, deflation, I am proposing that with the underbuilt scenario, we are going to have a massive inflationary period, and we're going to have an increasing interest rate environment. With an increasing interest rate environment, it's going to pressure stocks and bonds to go down because in an increasing interest rate environment, PE ratios contract, the risk-free rate of return goes up for bonds, so people are less willing to speculate in stocks. And what happens is if people think that this is going to be long-lasting, is they're going to go into inflationary hedges instead of going into a declining bond price environment. So they're more likely to put money into gold, into silver, into precious metals, and into commodities, and into real estate. And what are you seeing? Look for signs of people and very wealthy individuals investing in real estate, investing in precious metals, investing in hard assets. If you see that, that's more information that an inflationary environment is coming and that people are recognizing it. If you guys like this content, give me a thumbs up. Subscribe to the channel if you haven't already. And thanks for listening. This is Finding Value.